Hello, fellow traders. 'Tis I, the Rumpled One. It is Tuesday, December the 19th, the year 2017. Process versus results. I'm receiving messages, I guess, almost every day because I've been talking about stop loss. And it seems as though people aren't understanding something about stop loss, at least the way I see it, at least the way I understand it. Stop loss is part of risk and money management. And in a way, it has nothing to do with your trade. I know that might sound weird, but it doesn't. You see, when you put a trade on, you say buy here or sell here and then exit someplace else. That's what you're doing when you're trading, right? But the money management and risk management side is almost separate from the actual trading, because you see, up front you determine how much you're going to risk when you trade, and that risk is how much you're willing to lose on any particular trade. Because when you put a trade on, you do not know if it's going to be a winner. You don't know if it's only going to give you the opportunity to take 1 pip or 10 pips or 100 pips, or you don't know, it might not ever give you the opportunity to exit with the profit, not even 0.01 pip. I mean, as soon as you put the trade on, it goes against you. You just never had a chance. And so, because you don't know if and when you're going to have a chance to take a profit, you have to manage your risk and your money by saying, I am willing to lose X number of dollars when I trade. It's just, if you go to the casino and you step up to the crap table or the blackjack table, you put a certain number of chips in the little circle, and that's how much you're willing to lose on this hand. Well, it's the same way with trading. How much are you willing to lose? Because when you roll the dice, or somebody else rolls and you're betting, you almost know if you win what you're going to win. But you see, in trading, you don't know that. You don't know how much you're going to win. You can only approximate. You can say, well, based on statistics and of the range, I think I'm going to be able to, take 25 pips off this next trade. Well, maybe you do. Well, what if it gives you a chance to take 20 and then it reverses and hits your stop? I mean, is that okay? For some people it is. For others, it's not. So I hope I've cleared that up. But you see, today's topic is process versus results. You see, if you're focused on how much you're going to make, you're focused on results. But if you focus on, I'm going to take every trade when my entry trigger appears, that's the process. I am going to faithfully put my stop loss, execute my stop loss on each and every trade. You're focusing on the process, okay? So if you're only focusing on the money, you might mess up over here. And process is what produces results. Sticking to your process, sticking to your plan, should produce the results you desire. So, once again, this is my opinion. And traders, you guys are certainly well to disagree and trade however you want. But all I'm trying to tell you is that when you put the trade on, you don't know if it's going to be a 1 or 2 pip and then out, or if it's going to be a 10 or 20 and then out. You don't know. You have to be in the moment. You have to make the best decision with what you know at the moment. So I really hope that clears it all up. So let's take a look here and see. Oh, look, all the gaps filled. So once again, that little trade at the beginning of the week can pay off for you. It's not difficult. You just see where price opened versus the previous close, and you trade in that direction. And every now and then, you know, I think it was last week we didn't get that fill. I think it was the Aussie yen didn't fill. But you can see here we had a fill. And looking at the daily, okay, you can see here it broke the previous day's low. You can see here it crisscrossed across the open. Now we've got a couple of ranges in 3 digits. You can see some of these others are really stalling. And once again, the buy zone right here, there was an entry, and as I was just pointing out, sometimes you don't have an opportunity to make much. Maybe if you entered here, you could have pulled out at a couple of pips. Otherwise, maybe you took some heat and then maybe you took profit. Here was an entry, could have paid off. Once again, maybe you took that entry right there, took a little heat, and it would have paid off. As you can see, the rat zones are right next door to each other, but you could have still traded rat reversals for profit. Even though, obviously, if we pull up the daily chart, the range, only 40 pips, just not moving today. And let's cycle through. We'll look at the pivot. So here's the open, there's the pivot, a fade to the pivot. Could have paid off about, what, 16 pips. As you can see here in the beginning, it's going up. You could have, even if you started off, it was heading that direction. You can see here price action, lower high, breaking. You could have gotten out, could have retested a few times, and a reversal off the low. Once again, looking at price action, and here we've got the price action here, as you can see, looking at lower lows, lower highs, some higher lows there across. The multimeter lets you know on all time frames, so you don't have to flip through the charts. And here we have, just using the high, open, midpoint, close, and low of yesterday's candle, just trading the horizontal line crosses here. You can see there was a lot of action around yesterday's close, which pretty much is today's open. And you can see all that action, and you saw it back in the buy zone screen. And we'll look at the wick zones, in and out of the wick, poked out the bottom. Price does not like to stay in the wicks, the previous day's wick. And we'll look at the holo, highest open, lowest open. You can see here we had a highest open and it's coming down, and the lowest open right there. So that's it. Process versus results. So on any of these trades, it's all about process. Taking those trades, putting on the stop, taking profit when you can. So somebody would say, well, I don't, I risk right here. I might risk 10 pips to make 2. Okay, so you made 2. If you exited at 10, you could come back here and probably make those back. And if you stuck with it, then you would have definitely made it back. So, I mean, we don't know the outcome of the trade. We just don't. So you can either focus on the process, make sure whatever method or methods you're using, you're sticking to it. Whatever your trading plan is, you're sticking to it. You're sticking to your risk management, your money management. You're sticking to that stop loss and position size. You are totally focused on the process. And if the market smiles upon you, you exit with the profit. But you see a lot of traders, especially in the beginning, they'll have some minor success, maybe even big success, and as soon as they hit a rough patch, now they're ready to chuck the system and start fooling with it, as opposed to just grinding it out day after day after day with something simple. And then they kick themselves because as opposed to just sticking maybe with that one pair and just squeezing all that they can out of it, they go flip-flopping from pair to pair like a butterfly. I guess it's more, was it flitting like a butterfly, and they just miss it. They just miss the runs time after time after time. It's just like, oh man, I missed it. No, you chose because you did what you did. And you can see here, here's that daily open trade right there. Boom. So, or I'm sorry, not daily, that's the weekly open. So you see here, price went up, came back down. We talk about the weekly open a lot right here. Oh, that's daily. Go back to the weekly screen and you can see here the difference. Just trading that one crossover, the weekly open. Just wait and wait and wait, and you can put the pips in your pocket. I mean, look at the majors. Let's see, we've got the euro 73 to the up, got the pound 53 to the up, the franc 15 to the down, and the yen 8 to the up. And you can see here one of my favorites, the euro yen 92 to the up, and the B 64 to the up. So just trading something as simple as that weekly open crossover, just waiting for a price to hit it. And the thing is, you can put that trade on ahead of time. You can just have that limit order sitting there waiting to be filled, coming the other way. So if price is up, then it'll have to come down to the weekly open. You can have your short order already there. Or you could just set your alerts so your phone dings or you get an email or something whenever it happens. If you're not sitting in front of the screen. If you like to trade off, use your phone to do trading or your tablet. So I hope you guys understand it. If not, hey, keep asking questions. You know, it's no bother at all. I like to see those responses. But I really hope I've answered that question, because many people think that you're risking all that just to make a little bit. And you're right. I mean, if you do take a hit and then, you know, you might have to make it up in 2 or 3 trades. So what? And the thing is, if you keep doing something and you're losing on a regular recurring basis, then you have to take a look at what you're doing and maybe make a minor adjustment. Maybe there's something you don't understand. Maybe you're failing to execute something. Maybe you're missing something. You're not paying attention. So your focus is off. So let's focus on the process, and by focusing on the process, you'll get the result. And as always, fellow traders, it's not what you trade, it's how you trade it. TheRumpledOne off to drain the banks.